edition of BX Presents. This is Chris McKeffey, your host and the head of national sales at BX Partners. Very pleased to present today's topic concerning managers that really distinguished themselves in 2020. What are they thinking now? This is something that I think a lot of advisors and their clients kind of have interest in, and we were happy to be able to pull together a great panel to share their thoughts with you here today. We've got Brad Roth from Thor Financial Technologies. We've got Arthur Weiss from Kingsland Growth Advisors. The strategies that we're going to talk to you about from Kingsland are in search of next generation blue chip companies that can grow 500 to 1,000% that stock price over the next 10 years. We've got Dawson Ransome from Ransome Asset Management and Wayne Ferbert from Alpha DNA. Alpha DNA runs a number of hedged equity strategies, which we're going to mention today.
Dawson, your performance last year was excellent in your concentrated approach, up over 60%. So that's double a lot of the indexes we were just looking at. But talk for a second about your strategy and why it did so well in 2020.
Yeah, thank you very much, Craig. When I look back at 2020, I have to kind of look to 2019 as well, and we performed almost as well the prior year. And so what I attribute that to, at least from our perspective, is just the process that we use. So I look to try and purchase things at a discount to what our assessment of value is, limit downside, and try and maximize upside as a result, and look for a catalyst after we purchase. We're value driven, but also flexible. And then I think opportunistic. Last year was an example of having to be prepared and ready to adjust. There are things that nobody expected. And so part of our performance last year was really conviction when things started to fall apart, and we restructured the portfolio, bought some names that are more high growth that would typically I couldn't make sense of from a valuation perspective, and then we were able to participate as a result in some of the upside in the growth names as the year went on, and also maintain some of the more traditional value type names that have performed well towards the fourth quarter. So that balance and moving things around when the market fell apart served us pretty well. Remaining fact-based and objective and unemotional, I think, is really important, especially in the first quarter of 2020. So, a couple other things. The secular trends that are driving growth are really undeniable, and the environment's been really supportive of growth, partly due to low interest rates and what that does in terms of the price you pay. So I think those things will continue, and but certainly it was a very good year overall in 2020 for us.
Wayne, I'm going to turn it over to you. You built a firm that does some really interesting research and helps you guide towards what stocks and sectors will outperform others. So maybe take a second, introduce the research that you all do and what that turned up for you in 2020.
Yeah, I think first you guys must think I'm a ventriloquist, because earlier when Chris McKeffey was doing all that talking, you were like, that guy in the Chris McKeffey box, he's not moving his lips at all, right? Sorry, so I am Wayne Ferbert in the box that says Chris McKeffey, and I am one of the co-founders of Alpha DNA Investment Management. We're a hedged equity manager. We run 3 hedged equity strategies, a large cap version, a mid and small cap version, and an all cap version, which is really the combination of those first 2. If you know anything about hedged equity, sort of the name is very descriptive of what it does, right? You build equity exposure and you build a hedge, right? And most hedged equity managers also take some time to do something to pay for the cost of the hedge. We don't usually spend that extra effort on paying for the cost of the hedge. We actually instead focus our efforts on building a really good equity portfolio to help pay for the cost of the hedge. In 2020, what worked for us? So I just told you there's 2 parts of the portfolio, right? There's the equity and the hedge. Well, both parts worked for us, right? We have a quantitative systematic approach to both the equity selection that we do and the hedge construction, right? And so if you jump ahead a slide there, Craig, right? You'll see for the 2 strategies that we run, this is the collective returns of each against their benchmark since we launched them, the large cap in February 2017, the mid small cap on December 1st of 2018. You know, the large cap was up 26% last year. The mid small cap was up 35%. But you know, on March 5th or on March 23rd was the day the markets closed at their lowest close. It wasn't the lowest point of the markets last year during the sell-off, but it was the lowest close price of the year last year. On that day, the S&P 500 was down 30% on that day for the year for 2020, for just, you know, the 2.5 months into there. And the Russell 2000 was down 40% on that day. On that day, both of these two hedged equity strategies were down 15 and 14% respectively for 2020 as of that date. And so, you know, if you're going to have a hedged equity strategy, you want to not only see growth, because the promise of hedged equity is growth and downside protection. You want to see both. And so we certainly delivered the downside protection. If you jump forward one more slide, Craig, you'll actually see, you know, despite the markets finishing up 18%, right? We did a pretty good job adding some value with our hedges, right? Like the large cap hedges were just a slight drag, right? Normally, you would expect any year in which the markets are up, your hedges should be a drag on your portfolio because they represent some sort of regular insurance you pay to protect the portfolio. Heck, our mid and small cap, we actually made money with our hedge, and that's because we took profits during that volatility in March, reinvested them in the equity. You said we do something interesting on the equity side, Craig. I'll address that real quick. You know, the reason we were good at delivering an equity portfolio that had excess returns over the S&P 500 for the large cap and over the Russell 2000 for the mid and small cap was because the objective function that we go after, we were able to successfully achieve positive metrics in that objective function. That objective function is finding companies with hidden demand, finding companies that have demand for their products that Wall Street hasn't quite caught up to yet. And if you find those kind of companies and then Wall Street catches up to that demand, those companies are typically rewarded. And under all the metrics that we look at for the companies that we purchase in our portfolio, they were creating surprises in their earnings announcements. They were getting upgraded by analysts as analysts figured out they were selling more of their products than they thought. So we delivered upside on the equity side because we delivered smartly to our objective function, right, of what our research does. You mentioned our research. And on the hedge side, you know, instead of having a 6 or 7% drag, which is what you'd expect out of a roughly 30 delta hedging program against the market that's up 18%, instead we made a little bit in one and lost a little bit in the other. And effectively, both of those are materially better than what you'd expect from a hedge in 2020. So looking back on 2020, we delivered value in both parts of our portfolio.
Thanks, Wayne. Let's jump over to Brad at Thor. You know, you guys have built a lot of interesting strategies. One of which, the next gen, was, you know, up well over 100%, which I know probably wasn't easy looking back on it. You know, as Wayne was just alluding to, we had a little bit of volatility in February, March, and April, but plus you have other strategies that were in line and outperformed various benchmarks and strategies. But when you look back on what you did in 2020, what sort of stands out to you?
Yeah, I think if we're speaking specifically about the next gen, I think we did a really good job of picking the underlying assets that were being held in that portfolio. You know, we like to look for some of the most disruptive, you know, this year it just happened to be tech growth names that we can find and put them in that portfolio and get really, really focused in terms of having a very, you know, a very, my brain's just ticked off, a very concentrated portfolio. So we had about 10 names in that portfolio, equally weighted, and they all performed very, very well. But where we really had success is, yeah, the annualized return was great. But what we were most excited about was how we were able to manage risk to the downside. I think what Thor does really, really well is it manages risk in real time. And so we overlay that portfolio with our risk management system. We're able to, you know, not only deliver that return, but delivered it with a month-over-month drawdown of, you know, less than 6%. And so that was something we did very well. As Wayne was alluding to, the timing of their hedges as well as the timing of our risk-off mechanisms were pretty exceptional last year, and which drove our performance not only in the next gen portfolio, but in all of our other strategies. And so, if you look across the spectrum of all of our strategies, whether they're ESG focused ETF or global ETF, our max drawdowns since inception are very, very low in comparison to the market. I mean, we had a big drawdown in 2018, a big drawdown last year, and almost all of our strategies are sitting with drawdowns, sub 6-7%. And so we're very proud of that, and that's a big contributor to our success. So, that's what made us, very successful last year.
Hey, the digital economy accelerated growth. So Arthur, tell us about 2020. It was a great year. You have two strategies, the long-term growth and sustainable growth. Both were up over 100% last year. I know you're very excited about 2020, also very excited about 2021, but tell us a little bit about, your key observations as you look backwards.
Sure. So I am invested almost exclusively in the digital economy. We know that the first generation of companies is well known, FANG, Facebook, Amazon, Netflix, and Google. They emerged after the last downturn in 2009 through 2011. They drove the returns of the index over the last decade. And we have always been in search for the next generation. Our sustainable growth strategy includes companies that we think are generation 2, those that have emerged as leaders and we think are going to continue for some period of time. That strategy was up 113% last year. And generation 3 would be those that come afterwards, those that we are, we're placing some more bets. We're not sure if that they're all going to make it, but we think those that do are going to have some fantastic returns. And that is our long-term growth strategy. Last year was up 120%. This slide tells you the story of what's happening with the digital economy. It took a long time to build the infrastructure, build the connectivity that allowed all these companies to grow the way they have. And COVID basically unleashed that growth. So what this slide shows you is that Amazon emerged in 1994. There was not a lot of internet infrastructure. In years 10 through 17 of their life, they started to grow pretty decently. But a decade later, Shopify, similar concept, was able to grow vastly more robustly over that same time frame. And most notable is that you can see that year 17 for them, 2020, they doubled. Their business doubled. They now have about 6% of all e-commerce. And 6% is meaningful because it's single digit. Can they get to something considerably larger? Yes, they can. And in fact, what I search for are these companies that can grow considerably larger over the next decade. We saw that some of them grew quite robustly in 1 year, but we think that that's going to continue. So we believe that 2020 was the emergence of a new bull market. The leadership was established, and that leadership will continue over the next 5 to 10 years. But as we know, there's always a pause with growth. We're seeing a pause right now, but we're very excited about the future.